Hello and welcome to another episode of Fractional Impact. Today we're speaking to Allan Russell about how financial systems shape organizational culture, what it takes to lead change in high-stakes environments, and why credibility remains a company's most valuable asset. Allan, would you like to introduce yourself?
Yeah, thanks, Stuart, and thanks for having me here on the podcast. My name's Allan Russell, and I'm a fractional chief accounting officer based here in Toronto, Canada. I have a focus on high stakes, transformation, and litigation, and my vision is to solve the thorniest financial reporting issues that distract you from developing and growing your business. Prior to becoming a fractional chief accounting officer, I spent over 2 decades at Ernst Young, helping clients solve problems across a number of industries and literally serving dozens of clients. I also served as the managing partner of the Audit Center of Excellence, which was a shared delivery center that was responsible for centralizing and standardizing the audit procedures for certain key parts of the audit. And I also had the opportunity to lead our National Audit Quality Network. I'm delighted to be here today, and I look forward to sharing my insights on how financial reporting challenges that you're facing and how I can help you.
Awesome. Yeah, I'm excited to dive into all of that. We're also joined by Gianna Maliari from the Fractional Clients team. If you want to introduce yourself, Gianna.
Thanks, Stuart. As Stuart said, I'm part of the Fractional Clients team, and I'm super excited to get into everything today with Allan.
Awesome. So let's dive in at the deep end. Allan, you mentioned that you're helping companies with their thorniest issues, especially in finance. What are you finding that they are right now?
Yeah, I think, Stuart, at this point, there's 3 issues. Business acquisitions, raising capital, and dealing with the uncertain business environment that we're in. As it relates to business acquisitions, the one thing that I've seen is that there have been a lot of acquisitions over the last 6 to 12 months. I think this is likely a product of our environment, that there's certainly companies that are doing well, that have cash, and they're taking advantage of that cash to strengthen their position by acquiring those who might be struggling. Now, when a company acquires someone else, that creates a fair amount of disruption in the accounting that needs to be dealt with. First, there's the actual acquisition transaction itself, where the company has to take the amount that they paid and allocate that to all of the assets and liabilities of the company that they're acquiring. And it's just not as straightforward as using the book value that the company was recording it at. Rather, they have to determine the fair value at the date of the purchase. So you can imagine that can be quite a time-consuming and complex exercise to determine what the fair value is of things like customer lists or proprietary software, or perhaps unusual types of inventory that don't typically get valued on a fair value basis. But even once you've got all that done, you then have to worry about integrating the company into your own operations. You can imagine that going forward, you wouldn't want a similar transaction in 2 different parts of the company being treated in different ways. And so the acquiring company then has to take the time to integrate the accounting operations of the acquired company into its own finance team. This means harmonizing accounting policies, training staff on new processes, and making sure that everything can run in a seamless way.
Interesting. You mentioned there you mentioned that it's a very kind of unpredictable time in business, which I would agree with. So many people are saying that. And you're also saying that a lot of businesses have been bought and sold in the past 6 to 12 months. Do you think they're very related, where smaller players are worried, they're nervous, they want to get out and get their cash now, versus the bigger players are using this as an opportunity to buy more companies because they know that they have the cash and resources to sort of sail through the storm?
Yeah, no, I think it is related, Stuart. I think yes, maybe some smaller players are looking to get out. I think though it may be that there's some smaller players that are perhaps struggling and therefore are more receptive to an offer from somebody who's larger, who's looking to consolidate their position within a market. So if you think about it, if you're someone with resources, particularly in a market like Canada, where a lot of industries are very concentrated, this could be seen as a time to really strengthen your position if you believe that it's only going to be larger companies that are going to be able to dominate a particular field. And so I think that is certainly causing a key impetus for people to think about transactions like that.
Yeah, interesting.
Yeah.
Where do you?
Sorry, go ahead.
I was going to say, where do you fit into this as yourself, as a incredibly experienced finance leader? Where do you fit into these types of companies and transactions?
Yeah, so where I fit in as a fractional chief accounting officer is I can come into the company and help the company deal with the purchase price allocation. Most of the time, a company's going to hire valuation specialists to help them determine the fair values. But even though the fair values are determined, there are still a lot of intricate accounting rules that have to be followed, whether you're applying international accounting standards or whether you're applying US accounting standards. And what I can help with is navigating those standards to make sure that the information obtained from the valuators is properly translated into the financial statements. There's also some very specific rules as to how consideration gets defined in terms of, so for example, transaction costs are expensed. And so I'm able to be mindful of that and able to make sure that you're calculating that right opening number to be able to allocate in the first place. The second place, though, where I can then help is on the actual integration. In terms of helping to identify and harmonize what the accounting policies are, as well as to help with the training of the staff. And so really what I would say, Stuart, I'm looking to is this, or where I would fit in, is to say, as a smaller company in particular, when you've got a transaction like this, your finance team is already stretched thin. And so you're likely not going to have the capacity to take on a lot of the work yourself that's required by this. So I can act as that second set of hands to help deal with those issues, but I don't have the same commitment as what a full-time employee might have. Yeah.
And I can see how the sort of flexibility of working fractionally there would be of a lot of use to companies. Going back to those three challenges or trends that you're seeing recently, of there being a lot of acquisitions, with there being some challenges in raising capital, and then with the level of uncertainty in the general business environment right now. The middle one, raising capital. I've heard a lot of, you hear about all of this funding for AI companies, but it seems like for other tech companies, it's a really tough funding market right now. Are you seeing not much funding into other industries as well? Or are there certain industries that are getting a lot of funding? Or are there any other kind of insights or trends you're seeing there?
Yeah, what I would say, Stuart, is certainly companies with good projects are getting funding, okay? And I think that'll always be the case. What my experience is, though, is particularly in times like these, the financing arrangements become more novel, okay? So if you imagine a very large company, they're able to go to the bond markets and raise money using fairly traditional debt or very traditional equity instruments. But for a company that's smaller and perhaps has an emerging technology or has, say, is developing a mine, for companies like that, where there's a lot of risk, but also a lot of potential upside, the parties want to have a way of addressing the risk, but also allowing the debt holder to participate in that upside. Okay? And so as a result of that, you get financing arrangements that have a lot of novel features to them. So for example, I once worked with a mining company that it was a debt arrangement, okay, but it had an option that was based on future commodity prices. Okay, or sometimes there'll be conversion options where you can convert into shares, or other types of kickers that allow the person who's lending the money to participate in that upside. Okay, and where that becomes relevant to me is from an accounting perspective, under both international standards and US standards, accounting for those types of kickers is extremely complex. Okay, the rules are very detailed, they're very prescriptive, and if something's done wrong, you could end up with a financial result that you don't want. You could perhaps end up with your debt having to be marked to market at fair value with the changes going through your income statement in some cases. And so as a result of that, what I always used to tell clients was, obviously, if you need to, enter into the debt with the various kickers and so on, because that's the right business transaction to make. But make sure that you understand the implications of what you're doing and recognize that a part of the cost of issuing debt like that is the cost associated with making sure the accounting's done right, and that you maintain your credibility as it relates with respect to the financial reporting. And again, this is where I can come in and help, that if you've entered into a transaction like this, I can come and help determine what that accounting is and approve that accounting for you as a member of your management team, without having the commitment of having a full-time chief accounting officer.
Yeah. And on the flip side of that, what are the risks for businesses that are involved in these acquisitions and transactions if they don't work with someone like yourself and they try and figure it all out themselves?
Yeah, so what happens then, and unfortunately I have seen this happen, is you then get a surprise at the time that you're doing your financial reporting, because at some point the financial statements need to be done. You're going to have the auditor come in, and things aren't going to be ready for the auditor, or the auditor's going to tell you an answer that you weren't expecting. Okay, and then all of a sudden, then you're having to scramble at the last minute, or even worse, you could be delayed in your filing, or it might be that you get the filing wrong and then have to do a restatement, which obviously is a huge blow to your credibility if you end up in that position.
Yeah. And I would imagine as well, with your positions in financial leadership, that third issue that we touched on of an uncertain business environment, that your kind of role in finance leadership, that must be one of the toughest roles to have with such an unpredictable business landscape. How do you help companies, or how do you advise companies best to plan their finances, to plan for the future, etc., in such a strange economic time?
In planning for it, I think to a certain degree you can't really plan for it. Like, certainly if things change quickly, you've got to be able to respond. So I think it's making sure that the finance team is agile to really be out there looking to what's happening and being able to respond. But that being said, there's also things that you can do to be proactive. So for example, right now what I'm seeing is sort of three areas coming up as a result of the current environment. Challenges with companies having to take restructuring provisions. If a company is planning to lay off, say, 5,000 people, there's obviously a cost associated with that in terms of paying the severance, and that needs to be recorded at the appropriate time when the decisions have been made. We've also seen companies have to do impairment analysis. The risk is right now that with some of the declines in the market, that assets aren't worth what they're being carried for on the financial statements, and that there needs to be an adjustment for that. Or it could be that you've got a contract that's all of a sudden become an onerous contract, and need to have a liability for that. And I think what you can do is, knowing that we're in this environment, is start now in terms of looking for those issues as you approach your year end, assuming that you're a calendar year company and are going to say file in February or March. There's nothing that says that you can't start looking now to build a list of what might I have that our assets are impaired, what might I have that are potentially restructuring provisions out there or owners' contracts that are out there that I need to start thinking about how I'm going to account for them. Where companies get into the difficulty is when they wait until February or March to make those decisions and then have to scramble in order to get the financial statements done.
Yeah.
Allan, in a broader aspect, how do you personally stay sharp in a field that is constantly changing with regulations, market conditions, and technology?
Yeah, it's a great question, Gianna. What I do is I'm constantly reading. I stay connected with the thought leadership being issued by the firms and being issued by other key constituents out in the market. I also keep track as to what's happening with the standards and what are people thinking about with the standards, as well as what's going on in the economy in general. And I'll often ask, what are the key elements that are going on? Another thing that I do is just as we complete the reporting season for the third quarter, is I go and I look at financial statements to see what our company's doing. And this, for example, is where you can see that there's a lot of business acquisitions happening. I think the one thing that maybe struck me is that there weren't as many impairment provisions occurring as what I thought might. And what that would suggest, Jen, is that perhaps companies feel that there's plans to mitigate the risks associated with the tariffs, or to otherwise alter their operations such that there may not be sort of that long-term decline in value to the companies. Again, I think we'll learn more as we go into year end. And companies start to get their impairment analyses audited. And also we have more time to see where the market goes over the next 3 to 4 months.
Nice.
Interesting. You touched on something a couple of minutes ago to do with sort of onerous or an onerous contract provision. For a non-finance expert like myself, what is an onerous contract provision?
Yeah, an onerous contract provision is a concept that exists under international standards. It doesn't really exist under US standards, but what it basically means, Stuart, is if you've entered into a contract and that contract has become loss-making, what you basically have to do is forecast what the expected loss is and then accrue that loss at the time you determine that it's loss-making. Okay, so what it basically is doing is saying you can't just wait and recognize the loss over time. Rather, you have to acknowledge that you have this loss-making contract up front, okay, if you're not able to otherwise get out of it. So, for example, let's say I was a company selling auto parts to another company, and I entered into a 4-year supply agreement 2 years ago. Then the tariffs come along, and because the contract's fixed price, I'm not able to adjust my selling price to account for the tariffs, but my costs have gone up. Okay, and as a result of that, that's what's caused the contract to become loss-making. If I can't terminate that contract and the contract now has a loss, I would have to forecast what that loss is for the remaining 2 years, and that's what I would recognize today.
Right. And what do you mean by that's what I would recognize today? What does that mean in practice? Okay,
so let's say that the loss, ignoring discounting for a minute, let's say that the loss was expected to be, say $1 million. Instead of just recognizing that $1 million as it occurs over the next 2 years, I would have to recognize that $1 million as a provision today. So I'd take the loss today and I would set up a liability for it. Right. And the reason for that, the logic around that, is it tells the reader of the statement that there is that loss-making contract there. and that outflow of cash is going to have to occur.
Yeah, makes sense. And when you talk about the reader of that statement, who would that potentially be? The internal revenue authorities or a potential acquirer or someone else?
It'd be internal revenue. It would be your general shareholders. If it's a public company, then it's going to be anyone who would use those financial statements either to potentially make an investment decision or to consider lending money, and so on and so forth. If it's a private company, it tends to be more the banks, again, in the context of making funding decisions.
Yeah, interesting. Since all of the tariffs have came into conversation and an implementation over the past year or so, how much has that shaken up your role in the finance department of the companies you're working with?
It's had a fairly significant impact in terms of companies are now needing to think about what decisions do we change, what do we continue with, key capital spending decisions, how do we restructure our business? But again, as it relates more to me, really what the questions become is, are there onerous contracts that need to be recognized? Have impairments now occurred that we now need to think about? Potentially recording or at least testing for to see whether or not an impairment's occurred.
Yeah. And what about revenue recognition? Where does that fit into everything we've discussed?
Yeah, so revenue recognition is always complex. I wouldn't say that it necessarily is as dependent upon the particular business environment. And the reason it's always complex is just the nature of decisions that are always having to be made. So, for example, with revenue, some of the key areas that come up are when you've got revenue that's recognized over time. Say, like for a construction contract, then you've got to use percentage of completion accounting. With percentage of completion accounting, the key question is what's the expected cost to complete the contract? And you can imagine that number can change over time, and as it changes, that will affect the amount of revenue that you're able to recognize. The other key area that comes up a lot is selling items as a bundle. Okay, and I guess the best example here is the classic cell phone example where you subscribe into a cell plan, say for the next 2 or 3 years, and in exchange for doing that, the cell phone company gives you the free phone. Okay. Now you might think that the accounting would be, well, recognize no revenue on the phone and just recognize the cell plan as you earn the revenue. But what the standards actually require is that you have to recognize a certain amount of revenue today for the sale of that phone. And so what you have to do is estimate what you think the value of the subscription plan is on a standalone basis, and what you think that phone is worth on a standalone basis, and then recognize revenue on a relative value basis between those two values. So even though the legal contract may say nothing to the phone and $50 per month to the contract, you might end up recognizing like $200 for the phone today, and then something less than $50 on the cell plan going forward.
Interesting.
Okay, and you can imagine, Stuart. Sorry, go ahead.
Yeah, I was going to say, what's the impact of doing this revenue recognition in different ways? Does it help companies save on tax, or does it just mean they're a bit more transparent to their shareholders, or is there another outcome?
Yeah, I think really it's transparency to the shareholders. The reason that the standards are written that way is in sales contracts, they're obviously becoming more complex, where there's often many different things being sold within the same contract. And what the standard setters want to do is make sure that there's transparency as to what's being recognized for each of those elements. Okay, and so by having the accounting the way it is, that you have to allocate a certain amount of money to that cell phone, is more transparent or more representative of what's actually occurred. Because clearly you haven't sold the phone for free, because what you've said is, I'll charge $50 a month for the entire package. Okay. And what the standard setters are saying is, you can't just ignore the fact that you're giving that phone today. Had you not had the sell plan, you would have charged something for it. And so therefore we want to make sure that you recognize that and that the users know the value around that.
Yeah, interesting. And again, for a non-finance expert like myself, a lot of these issues and topics are quite complex, to be honest. I know that it's probably very simple for someone like yourself. But how do you translate these things into a clear and simple value proposition to the types of companies you're working with?
Yeah, so my value proposition, Stuart, is to relieve the finance team and the CFO of the burden associated with these types of issues. Okay, particularly for smaller companies. For example, when I worked in early stage biotech or early stage mining, most of the time the CFO is being brought in for their abilities to raise money, because quite frankly, that's the most urgent need of those businesses. They need to make sure that they're raising cash to get to the next developmental milestone and to be able to keep the lights on. Okay, so they're very gifted in terms of the relationships that they have with the underwriters and other market participants, where they're going and getting money. But what that means then is that they're not necessarily as strong at dealing with the intricate issues that we're describing. And yes, as you're sensing, these are complex issues that require a lot of time and thought. And so again, what I strive to do is to take that burden off the CFO's plate as their chief accounting officer, in order to allow them to maximize their time in the business, optimizing the business and managing that relationship with the stakeholders.
Interesting. Yeah, that makes sense. One thing I want to ask about, because you were at EY and you had some really cool leadership positions there, you must have learned a lot from the other people you were working with and how a company at that size deals with its clients and delivers value, etc. What were the biggest lessons there that you learned about scaling finance and culture as well? Because I know that's a big part of your role as well.
Yeah, in terms of scaling finance and in terms of building culture, one of the biggest lessons I learned is your people are your strongest asset. Okay, in terms of the people you've got on your team and the skills that they bring, is gonna drive your ability to succeed. And so when I learned to lead in a very focused manner, in terms of having a very clear vision as to what I wanted the team to be doing and what the team needed to be doing in order to achieve success. At the same time, though, I learned to be very collaborative, that everyone's view on the team was important, and that I really wanted to make sure that everybody's voice was being heard. Because the reality is, Stuart, if that buy-in doesn't exist, then it's going to be extremely difficult to get the result that you want to have.
Yeah.
Okay? And I believe this is what I can also bring, is being able to come into a company and not just sort of advise from the sidelines, but actually become part of the team as a part-time chief accounting officer, to integrate with them and to work with them as part of that team, to really make sure that we're all going in the same direction and that we get the result that we want in terms of solid financial reporting.
Yeah, because we've talked a lot about some of the nitty-gritty of your work and the different financial issues that you're seeing right now. So it's easy to kind of neglect the people aspect. How big is the leadership aspect in your role in companies?
I would say that the leadership aspect is huge. Again, you need the leader to be able to set the direction, to set the plan, and to sort of be out there saying, what are my key risks to financial reporting, and how am I then going to navigate them? it requires a lot of discipline, and it requires somebody who's really proactive and is able to work well with people to get things done. I think to me, one of the things that's unique about me is, in addition to having the technical expertise, is over the years I've been able to successfully work with people to inspire and focus them in order to achieve the results we want, whether that's trying to focus and inspire the team, an individual person, or key stakeholders. In one of my previous roles, I served as I mentioned, I served as the managing partner of the Audit Center of Excellence. This was an organization that I needed to scale, where we went from 20 people up to 50 people within a 12-month period. Okay, and wow. You can imagine, Stuart, that's not something that you just sort of do without a lot of thinking and a lot of planning. And so obviously I had to make sure that I had the culture I wanted. I was directly involved in the recruiting process to make sure that we were bringing in the people that we wanted to bring in to then have the culture that we wanted. Okay. Yeah. And the reality is, had I not had the buy-in of existing stakeholders, of the people that we were going to be helping in terms of the work that we were going to be doing, that never would have happened. And I really found that stakeholder management was absolutely crucial to success.
Yeah. How do you gain trust quickly when you're stepping into a company as a fractional CFO, Allan?
Yeah, so to gain trust, my philosophy is to get to know the person. So for example, when I took on the Center of Excellence, my first step was to individually meet with all of the members of the team. Now I recognize that can't be done in all companies if the company is very large, but in my case, it was about 20 people. For most finance teams, it's going to be a fairly small group of people that are sort of your key people. And so again, my approach would be to meet with the people, get to know them, and to build that trust by knowing them as a person. Then from there, I focus on vision, understanding where the business is at and what needs to happen in terms of the vision and how best to achieve that vision. But I've always found, Jana, that it's easier to be able to achieve that and get buy-in for the vision if you've built that trust up front by getting to know them as people and to have that initial relationship.
Interesting. One thing I was going to ask you as well is you've spent a long time in companies like Ernst Young and other very big companies, effectively. What made you want to separate from that and start your own entity?
Yeah, no, that's a great question, Stuart. I think to me, what it came down to is I really enjoyed my time at EY, and I certainly thoroughly loved dealing with the complex accounting issues and so on from more of a consulting perspective. But ultimately, I wanted to have some time in my career where I could work as a part of management. Okay? And to me, that's why I like my role as a fractional chief accounting officer, because it allows me to work from the other side as part of the leadership team to help drive some of these decisions in terms of what the financial reporting looks like in a way that you can't do as the auditor of the company or providing advice as a consultant.
Yeah, interesting. And when you are in these high stakes environments with bigger companies or fast growing companies, and you're working with the executive teams, and there's maybe a lot riding on different decisions or what happens in the business, how do you help people stay grounded and relaxed from your position in finance?
In terms of keeping people grounded, it's absolutely critical to do so. I think to me, proactively, what can be done and what I do is make sure that the vision is clear. In terms of making sure that people know what needs to get done and that we've planned out as best as possible what our project plan is going to look like. I think though from there, in terms of the day-to-day when obviously the stress levels go up, is I'm a really strong believer in promoting well-being and flexibility and making sure you're taking care of yourself. And so for myself personally, I actively participate in the martial arts in terms of practicing Taekwondo, Muay Thai, kickboxing, Brazilian Jiu-Jitsu. And I really find that helps me, Stuart, to stay grounded and to maintain focus as I deal with having to make some of those larger decisions that you talked about. And what I try to do with my teams is, obviously I don't expect everyone to do martial arts, but I try to encourage my team members to have something that's an outlet like that allows them to relieve the stress and stay grounded as we go about doing the work that we do.
Yeah, that's cool. Yeah, my dad is actually, he does Taekwondo and he got his black belt a few years ago. So that's cool that you do that.
Yeah, no, that's fantastic.
Yeah. Took a long time, took a lot of practice, as I'm sure it does for yourself as well.
Yes.
Yeah. So with all of that kind of experience, I know you're using it as well to mentor younger finance professionals as well. What are some of the lessons you're trying to teach them, or what are some of the potential mindset shifts that you're trying to instill?
I think the biggest mindset shift would be to ensure that you maintain balance throughout your career. It's very easy in public accounting, it's very easy in finance to allow work to consume you if you allow it to do so. And to me, Stuart, it's really about making sure that you keep that balance and make sure that you keep time available for those things that are important to you. The second thing, though, is then obviously making sure that you're always keeping up to date in terms of what's happening technically and in terms of what's happening in the environment. Okay, the reality is when I started, back a number of years ago, we still had some clients that were doing their books using the big 11 by 17 ledger sheets. Okay, whereas now we're talking about some of the finance function being done by AI, being done by bots and other features. So that's basically been the evolution within 30 years. And I think that evolution is only going to become even more accelerated as time goes on. And so I think for younger people, it's really about making sure that you stay agile as well and being adaptable to what might change, because nobody's going to be able to really predict the future that way. But everybody does have an ability to be able to respond as things come along.
Yeah, interesting. You mentioned AI there. Are you finding AI to be useful with regards to your work in companies? Are you using it at all, or are you finding it a bit of an obstacle, or maybe that companies are overly reliant on it or anything like that?
I think right now, Stuart, there's a real mixed bag. I haven't personally come across a lot of it. Okay, but I know of others who have, and certainly others have talked to me about where they're looking to implement AI in various spots. I think there certainly is a camp out there that want to be early adopters and do want to see what they can implement and get it in fairly quickly. I think, though, there's still obviously a lot of skepticism. Certainly when you hear in the news of some of the hallucinations that happen, particularly in the legal front, I think it rightly gives people pause as to say how do we approach this, and how do we make sure that we appropriately manage risk around it. Okay, I personally believe that AI is a way of the future, and that companies that ignore it do so at their peril. But I think it needs to be approached as a tool, no different than how you would use any other tool. Okay, or for example, how you would use other staff. The reality is, when somebody comes in at a university and onto a finance team or onto an audit team, there's always that risk that they make mistakes as well. Okay, and so to a certain degree, AI isn't any different. the key is over the years, the accounting industry has developed a whole protocol as to how things get reviewed to make sure those types of errors caused by inexperience get picked up and don't make it through to the final financial statements. Okay, and I think it's going to be the same with AI, that companies are building the controls around what's needed in order to make sure that if an error does occur, that the error is identified before it gets out into the financial statements where it can then cause an issue.
Yeah, it's fascinating actually how you compare using AI a bit like a new hire. I think that's the first time I've heard that comparison, but it actually makes a lot of sense now that you mention it. But I've never thought of it that way. So that's cool that you mentioned that. Gianna, I think you were going to ask something a couple of minutes ago.
I think just following on from that, looking forward, what would be a development or any sort of technology that excites you the most when it comes to the future of financial leadership? Allan?
Yeah, I think, Gianna, what excites me the most is the promise of AI and seeing how AI can be used. Like, for example, I was talking to a friend the other day and they were talking about preparing the financial statements. Okay, and the reality is doing the actual draft of the financial statements used to be something that was an incredibly time-consuming process. Wasn't particularly difficult, but just something that, if you can imagine, a 60-page document will take a fair amount of time to put together. Imagine, though, if you can, with the touch of a button, have the first draft of that 60-page document prepared for you literally within seconds. It obviously doesn't mean that draft goes out to the public, but it gives a much better base to start from than what might have existed in the past. I think also in terms of transaction processing, in terms of how we automate things and what that automation might be able to do to, again, save time on some of the areas of the finance process that maybe aren't as valuable as others.
Yeah, interesting. And with some of your experiences, I know you've managed large-scale transformations inside a Big Four firm. And when you're talking about these, big plans and changes in the industry and 60-page documents and stuff like that, I appreciate it's easy to create tons of plans and roadmaps and strategies and stuff like that, but then very little of them actually get implemented. How do you help companies actually implement all the sort of proposed changes and plans that you help them create?
Yeah, so on that, Stuart, it really comes down to execution, I think. And what I do is become part of the team and help lead the team to get there. So, for example, when I was building the Center of Excellence, that was something that was being built from very early stage, just out of development, up to into a core component of the firm's audit process. And what that involved was actively getting involved in the recruiting, actively getting involved in establishing and selling people on the services that we were going to provide. And so it's the same thing bringing in new technology. It's once it's been decided that, yes, this technology needs to come in, what I'll do is then say, okay, what now is preventing this from occurring? Okay, or what are the 5 or 10 things we need to do and absolutely do right in order to be able to see this successfully through to implementation? And what I'll do is get in and help the company actually execute upon those 5 or 10 things. It may not be me personally doing the 10 activities, but rather leading that team around it to actually drive the project forward. Because you're absolutely right. We can have all sorts of discussions around AI or think about, yes, it might do this or it might do that. But until somebody actually sits down and actually builds that roadmap and makes it happen, it's not going to occur. Okay. And again, I think this is where I can really come in, going back to what I said earlier. If you're running a smaller or mid-sized company, you've already got a number of other things on your plate in terms of maintaining liquidity for the company and in terms of maintaining the company's operations. And so this is where I can act as that additional set of hands to come in and relieve you of the burden associated with that implementation and become part of your team to actually see it through to completion.
Yeah, nice. Well, I think we've had a lot of really interesting insights and value from you today, Allan. Is there anything else you'd like to share with the audience at all?
Yeah, I think, Stuart, really what I share is just really coming back to what I said earlier, is clearly we're in a very challenging environment, and we're going to continue to be in that challenging environment for at least the next couple of years. At the same time, as companies restructure, finance teams are becoming more lean in terms of the resourcing that they have and having to be able to do more with less. On a day-to-day basis. And this is where I feel I can really help. I absolutely love solving these complex, thorny issues that you're facing that would otherwise distract you. And I can do so in a way that's more scaled to your operations, that doesn't have the commitment associated with bringing somebody on a full-time basis.
Fantastic. And for anyone that's listening that would like to get in touch, what's the best way for them to do that?
Okay. The best way, Stuart, is going to be via LinkedIn to send me a direct message. And certainly I'm happy to have a chat over LinkedIn or as an initial starting point. Or alternatively, you can email me. My email address is allan.j.russell@outlook.com. And if you email me, certainly I'm happy to set up a call and we can talk further in detail.
Awesome. Well, thanks so much for joining us, Allan, and chatting with us. Certainly for myself, a lot of interesting stuff and insights. So thanks again for taking the time.
Yeah, thank you, Stuart. Thank you, Jane. It was a real pleasure to be here and look forward to speaking soon.
Thank you, Allan.
To the listeners and the viewers, thanks for watching Fractional Impact, and we'll see you in the next episode.